Assalamualaikum to Dr. Wanzanani. I am Azzeda Ozzana binti Basa, S54848. Okay, today I will be presenting my individual assignment regarding the topic of financial statement analysis. Okay, let's take a look. I have chosen the construction industry, which consists of two companies that I've chosen, which is EKOVEST BERHAD and GAMUDA BERHAD. And then the ratio, I choose the solvency ratio. Okay, firstly, I will come up with the background of EKOVEST BERHAD, which is on 2nd January 1985, the founder started EKOVEST Binar Sdn Berhad, and this signaled the involvement in bigger and more technically demanding engineering project. This name was later changed to EKOVEST Sdn Berhad, following its convention to a public listed company in assume its new name, EKOVEST Berhad, on 28 August 1992 and listed in KLSE 9 August 1993. EKOVEST Berhad is emerged as one of the leading construction companies in the country, involving the major civil engineering and building works such as turnkey design and build projects and project management. Firstly, the company is presently operating in its headquarters at Wisma EKOVEST Taman Sri Setapak in Kuala Lumpur, supported by a group of highly trained and dynamic professionals. It has additional staff employed in various. Secondly is the background of GAMUDA BERHAD, which is established in 1976. GAMUDA has grown over the years to become Malaysia's leading infrastructure and property developer, a homegrown company steered by a global mindset, involving in multiple projects across the world, delivering exceptional solutions wherever we set foot. The company was incorporated on 6 October 1976 and was listed on main board of Bursa Malaysia on 10 August 1992. It was founded by Kun Yi Yin and Lee Yun Ling. GAMUDA Berhad is an engineering, property and infrastructure company based Malaysia. It was one of the largest Malaysia infrastructure company, has undertaken various projects locally and overseas, like the construction of Klang Valley MRT line, highway, airport, runways, railway, tunnel, water treatment plants, dams, infrastructure concessions, and the development of the new townships. Okay, I will proceed with the solvency ratio, which is the solvency ratio compare different elements of an organization's financial statement. The intent of this comparison is to discern the ability of target entity to remain solvent. Solvency ratio are commonly used by lenders and in-house credit department to determine the ability of customer to pay back their liabilities or their debt, which is I have 6 ratio solvency, which is debt to asset ratio, debt to equity ratio, debt to capital ratio, interest coverage ratio, and the time interest earned. Firstly, debt to asset ratio is a financial ratio that indicates the percentage of the company's asset that provide their liability. The debt ratio is a financial ratio that measures the extent of a company leverage. The debt to asset ratio is defined as the ratio of total liabilities to the total asset, which is the total liability divided by total asset, and we can get the debt to asset ratio. Okay. Firstly, for the first debt to asset ratio for EKOVEST Berhad, which is I took from the statement of financial position as at 30 June 2020 from data group, which is the total asset and the total liability. The total liabilities divided by the total asset, and then I get 0.7305. It indicates that 75% of EKOVEST assets are funded via liability. Okay, secondly is GAMUDA Berhad, debt to asset ratio for GAMUDA Berhad, which is consolidate from statement of financial position, total asset and the total liabilities, which is divided by the total liability divided by the total asset, get the 0.5160, that indicates 51.60% GAMUDA's assets are funded via liquidity. Okay. The debt ratio to asset of EcoVest and Gamuda Berhad is favorable and better for both company. It means that the both company have managed their debt or liability wisely as its own more asset than liability. EcoVest has a better debt ratio compared to Gamuda because EcoVest has high debt ratio 73.05% compared to Gamuda Berhad 51.60%, which means that EcoVest may be putting itself at the risk of default on its loan if interest will rise suddenly. A low debt indicates conservative financing with a opportunity to borrow in the future at no significant risk. The higher the ratio, the greater the risk associated with any operation. Next is time interest earned, which is measure the ability of an organization to pay its debt obligation. The ratio is commonly used by lenders to ascertain whether a prospective borrower can afford to take on additional debt, and the ratio is calculated by comparing the earning of business that are available for use in paying down the interest expense on debt divided by the amount of interest expense, which is EBITDA, which is divided by the interest expense. Okay. TIE for EcoVest Berhad, which is I took from statement of cash flow for the year ended 30 June 2020 for the profit before tax and the interest expense. I get 2.48, which is the company is 2.48 times. It means that the interest expense of the company at 2.48 covered by the its net operating income, which is the income before interest and tax. Next, for the Gamuda Berhad, I took from statement of cash flow the profit before tax divided by the interest expense, which is the commercial papers involving credits and term loans, plus, and then I get 1.89, which is the time interest earned ratio of Gamuda Berhad is 1.89 times. It means that the interest expense of company are 1.89 covered by its net operating income. EcoVest Berhad interest obligation are covered 0.48 times by EBITDA, while times interest earned ratio of Gamuda Berhad company is 1.89 times. It means that the interest expense of company are covered by its net operating income. EcoVest has a higher times interest ratio than Gamuda Berhad. Thus, relatively, EcoVest is a better financial position than Gamuda Berhad, and the lenders will be willing to give additional debt to EcoVest compared to Gamuda Berhad. The time to interest ratio of Gamuda is greater than 1. This indicates that generous sufficient earning to cover interest payment. Thus, the lenders may look at the factors like debt ratio, debt equity ratio, as standard. Okay, for the debt to equity ratio is a financial ratio indicating the relative proportions for shareholders' equity and debt used to finance a company's asset. Closely related to leveraging, the ratio is also known as risk, gearing, or leverage. The debt to equity ratio is calculated by dividing a company's total liabilities by its shareholders' equity. Okay, next for the EcoVest Berhad, which is the debt to equity ratios, I took from notes to the financial statement for the financial year 30 June 2020. Notes to 53 capital management, which is 2.63. Means that the liability are 263% of stock equity, or we can say that the creditor provide 263 cents for each 1 ringgit provided by the stockholders finance the asset. For the Gamuda Berhad, it is direct from the key performance indicators, which is the net debt to equity ratio for 2020 is 0.30 times. It means that the liability are 30% of stockholders equity, or the creditors provide 30 cents for 1 ringgit provided by the stockholder to finance the asset. It showed that the EcoVest Berhad used more debt financing over equity financing in their operations. In 2020, EcoVest with higher debt equity ratio is considered high risk to creditors and investors compared to GAMUDA BERHAD, which is a low ratio. GAMUDA BERHAD is a lower debt to equity ratio that usually implies more financially stable and indications of greater protection to the money. Okay, for the interest cover ratio is a financial ratio that used to determine how well a company can pay the interest on its outstanding debts. The ICR is commonly used by the lenders, creditors, and investors to determine the riskiness of lending capital to a company. The interest coverage ratio is also called the times interest earned ratio, which is the EBIT divided by the interest expense. Okay, for Ekovest Berhad, the interest coverage ratio, which is I took from statement of cash flow for the year ended 30 June 2020, for the profit before tax, and then for the interest expense, which is the profit before tax divided by the interest expense, I get 2.48. Which is the company is 2.48 times. It means that the interest expense of the company are covered by its net operating income. Okay, for GAMUDA, interest coverage ratio is I took from cash statement of cash flow, which is the interest expense consists of commercial papers, revolving credit, terms loan divided by the profit before tax. It means that the interest expense of company are 1.89 times covered by its net operating income. It indicates that 2.8 interest coverage means Ekovest is making 8 times more earning than interest payment times interest and ratio of GAMUDA company is 1.89 times. That means that Ekovest and GAMUDA will be able to pay the interest and principal payment a current liability without penalty. And it's also mean there's a good chance the bank will approve Ekovest and GAMUDA loan because the ratio shows the company is low risk and making enough money to cover the payable. Last but not least, the last ratio is debt to capital ratio, which is a liquidity ratio that calculates a company use of financial leverage by comparing its total obligation to total capital. In other words, this metric measures the proportions of debt a company use finance its operation as compared with capital, which is the total debt divided by total debt plus shareholder equity. A debt to capital ratio for Ekovest Berhad that I took from statement of financial position as at 30 June 2020, which is the total equity and the total liabilities, which is the total liabilities divided by total equities plus total liabilities, which is I get 0.73.05, which is Ekovest assets are funded by the liabilities. Next is the debt to capital ratio for GAMUDA Berhad, which is consolidated statement of financial positions, which is total equities and the total liabilities. Total liabilities divided by the total liabilities plus total equity, which is 0.5160, that indicates Ekovest assets are funded by liabilities. In these ratios, a ratio of Ekovest Berhad and GAMUDA Berhad is less than 1. It means both companies own assets than liabilities and can meet its obligations by selling its asset if needed. The lower the debt to capital ratio, the less risky the company. Ekovest Berhad had a better debt ratio compared to GAMUDA Berhad because Ekovest Berhad has a higher debt ratio compared to GAMUDA Berhad, which means that Ekovest Berhad may think itself at risk of default on its loan if interest will rise suddenly. This is same goes the first ratio, which is debt asset equities. That's all from me. Thank you.